If anybody would predict interest rates right 3 times in a row, they'd be a billionaire.
Well, I think people that are investing in individual stocks, it's sad they're careful when they buy a refrigerator or an airplane flight, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So
well, I think people in the decade of the 80s was the best decade this century for stocks. I think people managed to lose money in the 80s doing it themselves because their methods were so flawed.
Stocks are not lottery tickets. I frankly think it's a tragedy in America that the small investor has been convinced by the media they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all.
The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you can call the psychic hotline. But if you don't understand it, you're probably going to do the wrong thing. You know, if you understand exactly what they're doing, it's gone from 10 to 6, you'll buy more. If you're confused to start with, you'll say, well, there must be something wrong there. And then you're out. And then a lot of times stocks are going to decline. I mean, some of my best stocks have gone from 18 to 8, then to sometimes to 40, and some have gone from 18 to 0. But at least I wasn't adding to it on the way to 0. A lot have gone to 0.
So if it's going down, you're not adding to it? I mean, sometimes you are.
If the fundamentals are getting better or the same.
Yeah.
But if they're deteriorating, I'm going to leave.
I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. It's not a negative.
look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it.
Find something that you identify with. I remember there was a story of your wife and her hose. Your wife kept saying,
legs
these
and
are
the oh, you
legs,
got it.
legs and panties. Your wife said, these are the greatest things I've ever seen.
Right.
And when your wife said that, you knew that this was a product that was better.
Right.
You used to stay at La Quinta Motel.
Right.
And the service was better, whatever was better.
Right. The price was good,
and
too.
the price was good, too. And you said, this is a place that I can determine. I, Peter Lynch, can tell that this is a good product, right?
That's right.
And if these people are making a good product, then their earnings are going to go up, therefore the stock's going to go up.
Right.
And that's the kind of decision-making process you ought to go through.
Right.
Do I have it?
You've got it exactly right. Well, I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company, the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
On the positive side, information to the public is so much more available today. When a company releases their numbers and they have a call, it's open on the web to everybody.
Right.
All the information, we used to wait for the mail to come to see what Nike's inventories were like. You know, I mean you find out, we get in our library, in the first class mail. So all this information, so the investing for the average person now is much clearer. They know the same thing as I do.
Yeah.
They have all this, you don't want to invest in a company whose balance sheet is, you know, they got $8 billion in debt and you know, they have no cash and they're losing money. That's a terrible combination. You get all the information now. So information is a lot better than it was. You know.
And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts.
Is a 7th grade class.
Yeah.
The teacher of that read my book, and my first book that you were talking about. You and I did a show on that in Washington.
Right.
You remember that show?
Right.
This is
Right.
a long time ago. She read the book, and I said, if you made it through 5th grade math, you can do it in the stock market. She says, okay. She started teaching it in 7th grade,
Right.
7th grade class. These kids had to study companies. Right. They had to look at their balance sheets to see if they're solvent.
Yeah.
And they picked stocks. These stocks were up 69% over 2 years when the market was up only 20. And they picked stocks like Limited, they picked the Gap, they
Right.
picked Walt, they understood these companies. They also picked IBM. I lost money on that too. I mean, everybody makes mistakes.
Everybody did, yeah.
But I'm saying this was a school, St. Agnes' School in Arlington, Mass.
Right.
But in addition, in the decade of the 80s, there was 8,000 investment clubs. These are amateur, sort of
Right.
average people just investing. These investment clubs, 62% of them, of these clubs, beat the market. In the decade of the 80s, only 25% of professionals beat the market.
Right, let me go back.
There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated.
If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt, no cash. Which one are you going to buy? I mean, that's not too hard to do.
So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional.